In October 2024, German startup Lilium, the company that promised to free humanity from traffic jams forever with futuristic flying taxis, officially declared bankruptcy for its main operating subsidiaries. In the span of a single day, what had once been an ambitious technological marvel, valued at more than $1 billion at its peak, was reduced to a pile of legal paperwork on a bankruptcy administrator's desk. More than 1,000 world-class engineers, who had spent years building the transportation of the future in hangars outside Munich, suddenly found themselves out of work. Retail investors, who had continued buying the company's NASDAQ-listed shares until the very end, couldn't understand how a project backed by some of the world's largest venture capital firms and supported by government funding had collapsed so quickly. For years, Lilium's founder, Daniel Wiegand, repeated the same message at technology conferences. We're not just building an aircraft, we're creating a new era of mobility. After burning through more than $1 billion in capital, that new era amounted to nothing more than unrealized renderings and broken promises. But the most disturbing part of this story is that Lilium wasn't destroyed by engineering failures. It was brought down by a much deeper and far more ruthless mechanism that's quietly wiping out dozens of other technology companies right now. But we'll get to that in a moment. How do you sell an illusion worth $1 billion? Lilium's story began in Munich in 2015. 4 talented graduates from the Technical University of Munich believed the conventional helicopter had become obsolete. Why rely on a massive, noisy, and inherently dangerous rotor when you could build a sleek electric aircraft capable of taking off and landing vertically, an eVTOL? First designed to carry 5 passengers and later expanded to 7, the vision felt like science fiction brought to life. You open an app, book an air taxi, walk up to the rooftop of the nearest parking garage, step into a whisper-quiet cabin, and fly from downtown Frankfurt to Munich Airport in just 30 minutes, instead of spending 3 hours stuck on Germany's congested autobahns. Everyone bought into the dream. Some of the world's biggest investors lined up to back the company: Tencent, the Swiss private bank LGT, and venture capital firms from Silicon Valley. In 2021, Lilium went public on the NASDAQ through a merger with a SPAC, pushing its valuation past the $1 billion mark. To put that number into perspective, $1 billion isn't just an impressive figure on paper. If you divide all the capital Lilium raised by the number of flight prototypes it actually built, each prototype effectively cost investors around $250 million. That's more expensive than manufacturing several state-of-the-art 5th-generation fighter jets. On a per-employee basis, the company had raised enough venture capital to pay every member of its workforce an executive-level salary for the next 30 years, even if they never built another aircraft. Yet amid the excitement, almost nobody noticed the first subtle warning sign. In 2020, one of Lilium's early prototypes suddenly caught fire inside a hangar during routine maintenance after a battery malfunction. The company quickly downplayed the incident, dismissing it as a minor technical issue. Investors nodded along. At the time, no one wanted to admit the obvious. You can't negotiate with the laws of physics, and no PowerPoint presentation, no matter how beautiful, can change them. The anatomy of a fatal decision. Now let's strip away the marketing hype and examine this spectacular collapse for what it really was: a chain of management decisions, each one leading inevitably to the next. Decision number 1. Unlike competitors such as Joby Aviation and Archer, which chose large, highly efficient rotors, CEO Daniel Wiegand bet everything on a radically different design. Instead of a handful of large propellers, Lilium integrated 36 small electric ducted fans directly into movable wing flaps. At first glance, the idea looked brilliant. The aircraft looked sleek, futuristic, and, at least in theory, remarkably quiet. Investors loved it. This wasn't another oversized drone with passengers strapped inside. It looked like a business jet straight out of a science fiction movie. But that same design created an enormous problem, one hidden by elegant renderings and polished presentations. Small fans have a very limited rotor disc area. To lift a heavy aircraft carrying passengers and massive battery packs straight into the air, Those fans required an extraordinary amount of electrical power. In aerospace engineering, this is known as high disk loading, and high disk loading comes at a price. During vertical takeoff, the Lilium jet demanded more battery power than the civilian aviation industry could realistically provide. This is where the real drama begins. Instead of admitting the concept had reached its limits and redesigning the aircraft, management made decision number 2. Rather than solving the engineering problem, they tried to outlast it with optimism. The company assured investors that by the time commercial operations began in 2024 or 2025, battery technology would inevitably make a breakthrough. The batteries they needed simply didn't exist yet, but management acted as if they soon would. Lilium commissioned custom battery cells from outside developers, signed headline-grabbing partnerships, and spent hundreds of millions of dollars keeping alive the illusion that everything was still on schedule.
But this was only the beginning. Physics does not bend to the rules of the venture capital market. Battery weight kept increasing, the required power output continued to rise, and the actual flight range achieved during testing remained critically low. The company had reached a technological dead end. The point of no return had been crossed. Redesigning the wings would have meant wiping out 7 years of development and admitting to investors that $1 billion had been spent on a beautiful but unflyable machine. Instead, management chose to keep spending $20 to $30 million per month to maintain its massive workforce, hoping for a miracle. The era of cheap money. Why startups become zombies. If you think Lilium is just an isolated case of German engineering failure, you're seriously mistaken. It is part of a much larger global pattern that swept through the technology sector during the era of cheap money. In the venture capital world, there's a fitting insider term for this phenomenon: venture illusion. It describes startups that continue to raise capital and achieve ever higher valuations for years, not because they have a finished product or satisfied customers, but because they excel at producing compelling narratives and polished investor presentations. Think of electric vehicle startup Canoe, which raised billions on the public market by promising a revolutionary futuristic vehicle, only to end up filing for bankruptcy before ever reaching large-scale production. Or consider the Humane AI pin, created by former Apple designers and marketed as the device that would replace the smartphone. In reality, it turned out to be an overheating piece of hardware that fell far short of its ambitious promises. What all of these companies have in common is one thing: they were born during the era of near-zero interest rates, when venture capital firms poured millions of dollars into almost any idea, as long as it sounded futuristic enough. Success was no longer measured by a working engineering solution, but by media coverage, investor excitement, and hype. The problem was that once the era of cheap money came to an end and central banks began raising interest rates, investors suddenly stopped asking for glossy renderings and ambitious promises. They wanted real products, real customers, and real profits. That was the moment when the entire flying taxi industry began to collapse like a house of cards. The scam of the century, or the tragedy of visionaries. Who were they really? A less responsible channel might tell you that Lilium's founders were nothing more than fraudsters in the mold of Elizabeth Holmes and Theranos, that they knew from the very beginning their aircraft would never fly, and simply spent investors' money while selling an attractive story. But let's be fair and look at the facts objectively. Failure is the norm in deep tech startups, not the exception. By most estimates, around 9 out of 10 such ventures never make it to commercial deployment. Lilium's engineers accomplished an extraordinary amount. They successfully designed, built, and flew full-scale unmanned prototypes. The company became the first in the world to secure a concurrent certification basis for its aircraft from both the European Union Aviation Safety Agency, EASA, and the U.S. Federal Aviation Administration, FAA. Achieving this required years of engineering and regulatory work on a scale that simply cannot be faked. Lilium also built a real manufacturing facility, developed proprietary patented electric propulsion technologies, and recruited legendary aerospace veterans from Airbus and Rolls-Royce to its board of directors. The people behind the company genuinely believed they were changing the future. They knowingly embraced an enormous technological risk, the same kind of risk that has accompanied virtually every major breakthrough in history, from the Wright brothers' first airplane to Elon Musk's rockets. The trap of irresponsible scaling. Everything I've just said is true. And that's precisely why the real reason behind Lilium's collapse was neither a flawed idea nor incompetent engineers. The actual explanation is far more cynical. It lies in what we can call the trap of irresponsible scaling. Lilium did not fail because it lacked technological talent. It failed because the venture capital model pushed the company to scale a business that did not yet physically exist. Instead of remaining a small research laboratory with 50 brilliant scientists, patiently spending a decade solving the fundamental challenge of battery energy density through modest research funding, Lilium found itself forced to hire more than 1,500 employees, lease vast facilities, spend millions on public relations and marketing, and ultimately pursue a NASDAQ listing. The venture capital system can operate like a relentless pump. It demands either explosive growth and valuation or failure. Lilium's management became prisoners of the company's own valuation. They were compelled to burn millions of dollars every month simply to maintain the image and infrastructure of a large public company, even while their core technological breakthrough was still confined to laboratory testing. In effect, they were building the roof and the facade of a skyscraper, while the concrete foundation beneath it had yet to be poured. The geopolitics of innovation. Berlin versus Washington. But let's move to a second, deeper layer of this financial collapse, one that rarely makes the headlines of popular technology blogs. This is the realm of regulation and geopolitics. As Lilium began running out of the capital it had raised from private investors, the company's leadership made a last-ditch effort to save the business. They asked the German government for a 100 million euro state-backed loan guarantee. The proposal was straightforward. The federal government would provide half of the funding, while the state of Bavaria, where Lilium's manufacturing facilities were located, would provide the other half. Bavaria supported the plan, recognizing that the project represented not only thousands of jobs, but also a unique aerospace technology cluster. However, in October 2024, the Bundestag's Budget Committee blocked the federal government's participation. Constrained by fiscal pressures and domestic political disputes over public spending, Berlin ultimately decided that risking taxpayer money on what many critics viewed as flying toys for the wealthy was unjustifiable. At the very same time, a striking structural difference between the European and American approaches to innovation became impossible to ignore. While Berlin refused to commit 50 million euros to Lilium, the United States was directing hundreds of millions of dollars toward American competitors, such as Joby and Archer, through Department of Defense programs, NASA grants, and other forms of public support. In the United States, many deep tech startups are viewed as strategic national assets, with long-term implications for economic competitiveness and technological leadership. As a result, the government has often been willing to support them through years of losses, while critical technologies mature. Europe, by contrast, largely left Lilium to face the full force of the private market at the worst possible moment. Whether government intervention would ultimately have saved the company remains an open question. But Berlin's decision removed one of Lilium's last realistic financing options, accelerating a crisis that soon became a legal and financial collapse. Castles built on sand. 2 lessons from a billion-dollar collapse. Let's return to where we began, to the empty hangar outside Munich, where sleek white Lilium jets were once assembled. Now that we've examined the economic and strategic forces behind the company's downfall, that vacant building looks very different. It is not a monument to bad engineering. It is a monument to a systemic failure in the way an entire generation of investors approached innovation. This billion-dollar collapse offers 2 fundamental lessons that extend far beyond the aerospace industry. The first lesson: marketing can temporarily override market skepticism, but it can never override the laws of physics. If the economics of your business, or even your personal financial strategy, only work on the assumption that a miracle will happen in the future, then you're building a castle on sand. Lasting success can only be built on what demonstrably works today, not on what might work tomorrow. The second lesson: be wary of any system that pressures you to scale before you've proven your core viability. That principle applies not only to startups, but also to small businesses and even individual careers. Trying to look bigger, stronger, and more successful before you've established a solid foundation almost inevitably leads to what we have called the trap of irresponsible scaling. The FOMO syndrome. Why do some of the world's smartest investors keep making the same mistakes. If we want to understand Lilium's story at a deeper level, we need to look beyond engineering and finance to the psychology of modern venture capital. How is it that some of the world's smartest people, managing multi-billion-dollar investment funds, continue to fall into the same traps? Part of the answer lies in FOMO, fear of missing out. When Elon Musk transformed Tesla and SpaceX into two of the most valuable technology companies in the world, the investment community realized it had underestimated the birth of a new technological era. From that moment on, no venture capitalist wanted to be remembered as the person who turned down the next visionary founder. The pendulum swung in the opposite direction. Investment discipline weakened. Instead of spending months rigorously evaluating engineering feasibility and execution risk, many firms competed to write checks as quickly as possible before their rivals did. Startups quickly recognized this shift. In many cases, attracting top-tier communications specialists, branding experts, and world-class 3D artists became almost as important as hiring exceptional engineers. Lilium's promotional videos, for example, were cinematic in both quality and ambition. They showed elegant white aircraft silently gliding above modern cities, while impeccably dressed professionals enjoyed coffee during their morning commute. The vision was so compelling that many investors became captivated by the future it promised. They were not simply investing in a company. They were buying the opportunity to participate in what they hoped would become the next technological revolution. This psychological trap extends far beyond billion-dollar venture funds. It also affects ordinary retail investors who pour their savings into the latest fashionable cryptocurrency or fast-growing technology stock simply because everyone else seems to be doing the same. The combination of FOMO, the cult of rapid success, and the belief that every disruptive technology will inevitably become the next Tesla created an environment in which many companies could survive only as long as fresh capital continued to flow. Once that flow slowed, the illusion often disappeared, leaving behind mounting losses, disappointed investors, and businesses that had never achieved economic self-sufficiency. Lilium's collapse should serve as a reminder that innovation alone is not enough. When the financial storm passes, the companies that remain are usually those built on disciplined execution, sustainable business models, and genuine operational efficiency, rather than perpetual fundraising. Lilium's story is ultimately a reminder that successful investing requires more than optimism. It requires skepticism, careful analysis, and a willingness to distinguish genuine technological progress from compelling narratives. Flying transportation may well become part of everyday life in the future, but that future is far more likely to be built through patient engineering, disciplined capital allocation, and years of incremental progress than through hype alone. If today's story made you pause and take a fresh look at how the world's most ambitious technology companies really operate, and where billions of dollars in investor capital can ultimately disappear, then make your first smart investment today, and it won't cost you a cent. Subscribe to the channel, turn on notifications so you never miss a new episode. And if you found this analysis valuable, give the video a like. It helps the algorithm recommend thoughtful, in-depth content to more people. I'll see you in the next episode.